Welcome to another episode of Commercial Property Roadshow. You're here with Helen Tarrant. Today I'm going to talk about yields and how that impacts you, the lowering yields and what that looks like if interest rates going to rise and what that means to you in terms of building a portfolio. I think it's really important to address this front on this year, especially the beginning of the year, because we are going to see interest rate rise a little bit this year. We've already seen some of that movement late last year, so we're seeing that now come through. We're going to see LVRs change because we're seeing some banks now giving a little bit higher LVR. We're going to see commercial being very competitive with residential, but we're also seeing compressing yields or returns in the residential space. And there's a lot of people who are not confident or scared out there, and there are a lot of people who are boisterous and going out there. And fortune do favor the bold, but you've got to take calculated risks. So let's talk about yield and how that impacts you in terms of lowering yields and what that means. So let's say $50,000 is your net rent. So that's rent coming into your bank account after expenses and after your outgoings. So your rates, your water rates, your council rates, insurance, maybe strata, depending on the type of property you have, or building insurance, management fees, land tax, etc., etc. Right? Net rent $50,000. Right? This is before mortgage, but obviously this is net rent. Net rent comes in, and if it was ordinary in the run of things, let's say you were buying, let's say 18 months ago, because 24 months is too long ago. That's a lifetime ago. 12 months ago is, the market's already started to fluctuate. So say you bought 18 months ago, $50,000 net rent in a metro area, really good tenant, a great location, maybe 3 or 5 year lease. You're probably getting 6% yield 12 months ago. 18 months ago, probably that would be an allied health or medical tenant. But today, no. So today, that tenant might be 5% at best. So when you've got into it 12 or 18 months ago, you paid $833,000 for this property because it's $50,000 and the yield was at 6%. Now, today, in today's market where the yield goes to 5%, your property will be sold at $1 million. So now, the difference between a 6% yield and a 5% yield is a 13% gain in capital growth or in price increase on the property. But what does that mean to you? Now, yes, admittedly, 18 months ago, the interest rate is also higher than it is now. So at $833,000 when you bought it at 6% yield, you're going to be clearing 3% margin between what the bank lends you and what you get in your pocket. And you're also borrowing less as well. So essentially, out of the $50,000, you are going to be clearing probably close to about $30,000 of that. So roughly your $30,000, maybe a little bit less if you take out a few extra costs. So let's call it $27,000 to $30,000. Now, today, you are going to clear less cash flow. So at $1 million, your borrowing's a bit high. At 3%, you will now be putting out $30,000, and out of that $50,000, you're killing about $20,000. So you actually end up with about $10,000, close to $10,000 less cash flow, and you've paid 13%, more than 30%, but $130,000 more on the purchase price of the property. So that's what lowering yields means to you for your portfolio. So it means that you now have to have a greater deposit. On $833,000, you probably only needed a $250,000 deposit to get in. At $1 million, you'll need somewhere $350,000. So you need an extra $100,000 to get into the property market in the property deal as your first starter property. You're clearing $10,000 less cash flow, yet you're putting more money for that property. So as you build more portfolio, what this means is that you need more money in your kitty. You need to accumulate more deposit to get the same cash flow that you wanted to build in the beginning. So if you wanted $100,000 passive income 2 years ago, it probably would have cost you maybe somewhere around $1 million to $1.2 million in deposit to get there. Today, if you want to clear $100,000, you're going to need close to $1.5 million. So that's the difference, which means that because of the devaluing of money and the increase in the increase in the purchase price or the value of the property, because we've seen assets boom, we are now paying more for the property. So what do you do next? How do you build a portfolio that is really going to help you accelerate? So firstly, you do look for high yielding properties. You put cash flow before growth for a little while until you can build out a substantial cash flow. Then you come back to growth. You build properties that are in areas that hasn't boomed yet, so it hasn't had the influx of the people coming through. So for example, a Sunshine Coast has 1 in 3 southern investors in there. I would avoid the Sunshine Coast myself personally now for our clients, because the yields are just crazy. Great for a seller, not so great for a buyer. So, but if you want to be in that market and you're happy to pay the yield and happy to pay the premium, absolutely. But then you wouldn't need a buyer's agent. You only engage a buyer's agent because you want to go into markets that other people hasn't explored. You want to go with someone who is on the ground looking at property. We've looked at the certain areas we've been monitoring for 4 or 5 years now that are in regional that are just starting to turn, and we know that in the next 12 months it will turn and the yield will start to compress. So it's a great time to get in as well. And so this is why you engage a company like us to work with you, and we're a small boutique company that works with you to build your portfolio. So that's one of the strategies, is to buy in areas that hasn't boomed, and when it has boomed, then pull out the equity and do it again. Look at properties that you can obviously manufacture and engineer growth, but you can't do that in metro areas where the yield is so tight, because the value of land has also gone up in those areas. So if you're looking at anything with development potential, anything with an uplift potential, instead of paying even 5%, you're paying 4.5%. You're paying 4 and 4.5 or 4%. So on the flip, you're not going to get anything. So that's also a downside to that as well. So when you're looking at flips, you need to look at regional towns more, because the land hasn't crept up as far. Also, there's large regional towns where people are bidding crazily. It will correct itself in 2 to 3 years' time. So be very, very careful that you're getting the right yield, the right return in those areas. And then, of course, finally, how do you get more cash flow into your property? Once you settle on the property, start tweaking the property. Look at ways to increase more cash flow. So potentially, renting out a car space. Could you add an ATM in there? More storage into the area. Do an extension on your property so you could charge for more lettable area. Mezzanine floors, make sure they're compliant. So all of those things are going to tweak the property, and then because the market is rising, it's a great time for you to tweak the property and then refinance against it, and then pull out the equity and do it again, or just simply bring more cash flow so that you can build the same amount of cash flow. Unfortunately, when we have this rising market and the yield compressing and the value going up, is that you end up needing to pay more for a property, which means that you have less in your pocket, which means that you have to actually be more cash flow driven than ever before. So if this strategy sounds a little bit complicated, it is just what's happening in this market. The market will change, but at this moment, the next 12 to 24 months, it's likely that we are going to be in a seller's market. We're going to see strong growth in the commercial property space all across, not just in the warehouse space. We're going to see it flow through to retail, and then we're going to finally see it come back to actual office spaces. And those people who have bought office spaces now, this year, will reap the benefits 2 to 3 years down the track. So if you are looking for someone who can give you solid, concrete strategy on what you need to your portfolio, what you really need right now to build longevity in a portfolio, some different strategies, some properties that are less, the investors aren't always chasing, areas that maybe other people have overlooked that you're not, that they're chasing metro major areas like Gold Coast, Sunshine, Brisbane, perhaps more of the larger regional areas, perhaps a Lismore, perhaps a Ballina, perhaps going to Wagga, perhaps even going to regional Victoria, into Adelaide, ACT, or maybe even different parts of regional Queensland could work for you as well. So that's something we can have a detailed conversation about. So don't forget, if you're on this channel, hit the bell, subscribe, and so I can give you a lot more tips on commercial property. This year is a key year. If you want to get started in commercial property, start it right with your strategy session. Reach out to me, helentarrant.com, and get onto a strategy session. Email me and let's talk. Until next time. If there is a particular topic you like, please post it below. If there's any questions you want me to answer, post it below, and I look forward to sharing with you and really telling you where the market is sitting in my subsequent videos in the next couple of weeks, because I'm seeing listings now in this market coming through for the agents. I'm also exploring what the vendor's expectations are, and I can tell you that what the market is willing to pay, what the vendor is expecting, there's a mismatch. So I'm going to let the market go for a couple of weeks, gather some of that data, and I can come back to you with an update of where the market is going. So until next time, keep hunting, keep looking, build a strategy, and build a commercial property portfolio that is cash flow rich.